please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Two-day meeting of the RBI's Monetary Policy Committee began today, and all eyes are on the crucial policy decision tomorrow. Like always, the results of the CNBC TV 18 survey are in. Ritu Singh joins in with what the street is expecting from the RBI. Ritu, what does the poll throw up? No surprises expected tomorrow.
No rate hike and no rate cut. That is what all of the respondents to CNBC TV 18's poll said. And the factors governing this no-action policy this time around will be the rising threats to inflation, the stability in growth, as well as uncertainties on the macro front that loom large. We asked our respondents if they see any change in the 6% repo rate in the upcoming policy. As I said, 100% said no change. For the entire fiscal year FY18, we asked them if there will be any more rate cuts. But 90% believe that this is the end of the rate cut cycle. We will not see any more cuts, given the fact that inflation reading at the last point is already dangerously close to that 4% target inflation mark that the Reserve Bank of India has. Cash reserve ratio is also something that none of the respondents are expecting any change in, despite the fact that liquidity remains quite ample in the system. On the macro parameters is where the interesting data comes up. Remember the last time around, as far as the GVA growth forecast for this year is concerned, the RBI had lowered its forecast to about 6.7%, and this time around in this policy, 50% believe that that will be maintained, but there are quite a few that believe that that growth forecast is too ambitious and may have to be lowered down in this policy or the next one before the close of the fiscal. On the inflation front, and this is the key data that RBI monitors and that actually decides the trajectory of the rate cuts, the majority believes that the inflation forecast will be maintained at 4.2 to 4.6%, which was increased in the previous policy. Remember, 20% believe there could be an upward bias to this forecast, but no change per se. As far as the stance is concerned, again, 100% believe that RBI will stick to the neutral stance, which means it will not cut or hike for now until more data emerges. And lastly, the tone of the policy is something that is very important and will be watched out for, because that gives the cues to what the RBI is thinking in terms of the trajectory of rate cuts. And maximum number of people that we poll believe that the tone of the policy will be very similar to what we saw last time around. So no surprises at all. It seems like a no-action policy, but any threats to fiscal slippage is something that could play spoil sport.
Okay, fair enough, Ritu. Thanks for joining in with that. In fact, Lata caught up with the CNBC TV 18 Citizen Monetary Policy Committee, and the unanimous expectation is of a no rate cut, exactly as Ritu was pointing out. Take a look.
It has to be seen in the context of the first quarter. In the first quarter, we do know what happened. It came down. There was a destocking issue. We knew the destocking was going to get sort of overcome in the second quarter. That showed up in manufacturing. The problem, of course, is we don't know, where we are on the cycle.
Samiran, the growth looks like needs less support now. Would you say?
I don't think we need any particular stimulus at this moment, but at the same time, we should ensure that there are no more headwinds coming, which will kind of derail the growth process at this moment. Let's face it that global growth it cuts both ways. While it helps us increasing exports, at the same time we have to be worried about the commodity price impact coming out of it. So from that perspective, we have to be much more careful. We have just done significant structural reforms.
Sonal, let me get the global context as well in. Do you think the global growth is extremely positive? What should we expect in terms of rate cycles as well as global commodity prices? What should the MPC worry about?
The world that we are stepping into in 2018 as of now does appear like this Goldilocks kind of a scenario can continue for the foreseeable future, and a bit of policy normalization continuing from the Fed on both rate cycle and on the balance sheet normalization. The European Central Bank, we think, will announce a tapering of its asset purchase program mid 2018, and we have a lot of other global central banks also normalizing.
How worried should we be about inflation? I'll come to growth as well.
Yes.
But inflation?
Lata, so I think since the last review, all the inflation risks have moved in one way. Oil prices are now 12% higher than they were when the RBI last met. They're 12% higher than what's presumed in the RBI's inflation forecast. You saw some unseasonal increase in vegetable prices. Global commodity prices, metals have gone up. But I think most importantly, if you look carefully at core inflation, and this is not trivial because you've got to adjust for petrol, diesel, housing. What you see surprisingly, or at least at the time, was that core momentum both in September and October was quite steep. Prices went up 0.5% month on month, seasonally adjusted, right? This was not GST related because the GST impact was July and August. Now that makes sense. If you look closely at the GDP numbers that came out, the headline understates the kind of recovery in the private sector. Adjusted for agriculture and government spending, we've gone from 3.8% in the first quarter to 5.5% to 6.8%. So now the pieces kind of add up that India's domestic recovery is nascent, but is occurring, maybe a little more strongly than the headline numbers suggest.
Soumya, I wanted the fiscal picture. One of the big problems that the MPC bothers about, will we see a fiscal slippage? How should the MPC add up those numbers?
See, in terms of the fiscal, I think there is a lot of, consternation in the market in terms of a possible fiscal slippage.
That was the Citizen Monetary Policy Committee. You can catch all the action from the RBI Monetary Policy tomorrow all day on CNBC TV 18. Let's get you another exclusive interview. The government is planning to address the lack of long-term power purchase agreements by making Power Trading Corporation a power aggregator of sorts. Now, that's the word coming in from Power Minister R.K. Singh in an exclusive and rare interview with CNBC TV 18's Anshu Sharma. The minister also talked about the stressed assets in the power sector and said that the state-run NTPC will take its own decisions as far as bidding for insolvent assets is concerned. Here's an excerpt.
7 plants will be brought on stream as soon as this Shakti takes effect. That Shakti auction has happened. The coal mines have been allotted. Now only some signature was pending with the Ministry of, with the Coal India Limited. And the Coal India Limited board was supposed to meet yesterday. I think it met yesterday. So I'll have to check up as to whether they signed. If they have signed, then that will take 7 more off. Now 6 or 7 are those where the work had not got off the ground, so they were not really nothing has happened as yet, so could not be salvaged. And there are some assets which were complete or near complete which do not have PPAs. Then we have worked out a scheme whereby the Power Trading Corporation will aggregate about 3,000, 4,000 megawatts and sell it in medium-term PPAs to different states. This is market creation for those assets. So we are working on it. But I told you as to why it happened, and we are working to salvage as many as possible.
Which are the states that will buy from Power Trading Company, and how much is the capacity?
They are scouting around. There is one thing more which I have in mind. And that is that I've got a study conducted. The file has come to me. I'm examining it. Let me examine it first. But basically, my idea is that if any entity has a license to distribute power to a particular area, they should show to the regulator that they have tied up sources of supply to meet the requirements of power of that area. And only then should the license be granted or renewed. Now, this means, what I'm saying in other words, is that the PPAs must be there.
Yes. NTPC has just given a tender for 500 megawatt, looking for some of the projects, specifically some of the brownfield assets that they're looking to take over. Will that be also one of the routes, since PPA is not in the market?
No, as far as the NTPC taking over some of these assets are concerned, that will be a commercial decision.
Here's Here's the other big voice of the day. The Bharat Forge stock has been on an upward trajectory for the last few sessions. The rally appears to be fueled by steady rise seen in the North American Class 8 truck orders, which were up 68% in November at about 32,400 units compared to 19,300 units in the same period last year. The company garners about 12% of the revenues coming from this Class 8 trucks in America. We spoke to Baba Kalyani, the founder of the Kalyani Group, and he remains very bullish on North America truck sales. More importantly, he also confirmed that the company will be increasing its capex and will start investing in new capacities. Here's what he told us earlier today.
We are right now getting into a capacity expansion cycle. We are now going to increase our capex. We are going to build new plants and increase capacity because we see by next year our capacities are going to be completely full. After a very, very long time, we are going to invest in new capacities. So we are seeing very strong demand almost in every market and every sector.
Okay, on to an exclusive news break. The auto industry has sent an SOS to the government claiming refund on exports to the tune of 2,000 crore rupees. Ronoja Banerjee has exclusive details on the story. Ron, what exactly has the auto industry told the government so far?
Well, this was part of the pre-budget meeting that the auto industry had with the government late last week. Now, it was supposed to be pre-budget, but overwhelmingly, I'm told the meeting was to apprise the government of the after effects of the GST. Here are 3 or 4 key issues the auto industry has raised. One that you've already mentioned. The auto industry is claiming that export refunds to the tune of 2,000 crore rupees has not been made so far by the government. In fact, ever since GST was implemented from July onwards, these refunds have been stuck. Because if you remember, in the pre-GST regime, the compensation cess on exports ranged between 1% and 4%. Post-GST, that has now gone from 1% and can go right up to 22%. And the companies, and this is what my sources are telling me, the worst affected companies here are companies like Ford Motor Company, Volkswagen and Nissan. For Ford alone, the overall outstanding is about 500 crore rupees. Apart from that, the auto industry has also sought for a rationalization of the GST rates. If you take into account the cess, the overall the GST slabs can go up to as high as 6, depending on the category and the size of the vehicle. This, the auto industry has said, should be capped to 2. Apart from that, a concern that the industry has had in the past to address the inverted duty structure on electric cars. While the GST on electric car is 12%, but IGST on, let's say, on electric motor or a battery can be as high as 28%. So they want a rationalization on that front as well. And they've also urged the government to continue with the R&D benefits that, which was announced much earlier, which expires as of 2020. That should be continued for a few more years because the auto industry, as you would know, is investing a lot in the kind of transitioning from BS4 to BS6 and a whole host of other technological changes are taking place. So that's as far as the auto industry's plea to the government is concerned.
Okay, Ram, thanks for taking us through that. Now, let's take a look at the flashes on your screen. The government has unveiled its midterm review of the foreign trade policy. Here are a couple of points that have been outlined. The midterm review, essentially, the foreign trade policy will continue to have a dynamic character. The other point is the reference to import-export. The entire import-export code has been simplified. There have been a couple of points as well in terms of the amount. For instance, about 8,450 crore rupee of incentives have been included in this trade policy review. Current export incentives are at about 25,000 crore rupees. Self-certification scheme for duty-free imports for export inputs have been introduced. My colleague Rituparna Bhuyan is at that press conference. We will try to get through him and cut across to that important press conference for the key highlights of the foreign trade policy review. In a short while, we'll take a quick break. But up next, Uttar Pradesh government cracks down on realty companies, orders Noida police to arrest 8 developers for not developing and delivering 5,000 flats. More details after the break. Well, Welcome back. A quick check on how the equity markets fared in trade today. For the major part, the last trade traded in the red, but witnessed a late recovery in the last hour. So if you look at the Nifty, by the end of it, it ended about 10 points in the red, but held on to that 10,100 mark. Sensex closed about 1/5% in the negative. The Bank Nifty outperformed, led by the PSU Bank Index. Mid-caps also managed to end in the green. Let's bring in Anuj Singhal to take us through the day's trading action. Anuj, a late comeback from the bull seemed to be the saving grace today.
Well, big fight back for bulls after what looked like another ugly day, at least in the first half. The financials led the recovery and the market has defended a key level once again. I spoke about 10,100 being line in sand. That's been defended on closing basis. Financials led the rally. The top three index gainers were all financials: Bajaj Finance, Yes Bank and State Bank of India. Reliance also did good for the bulls. In fact, that held one end up through the day. Along with that, Bharti and IndusInd Bank were also higher. On the losing side, couple of stocks like Wipro, Hero, ONGC, though they don't count for much, UPL, Tata Steel and Eicher Motors as well. In the F&O space, you had big gainers. Shriram Transport was your top gainer. Jet Airways had a big move in late trade. Balkrishna Industries was strong through the day. And some other mid-cap gainers today included names like Praj, which was locked on circuit, Netco Tiles and Setco Automotive. All in all, bulls should be reasonably happy. And I'll repeat what I said yesterday, 10,100 remains the line in sand.
Okay, fair enough, Anuj. Thanks for joining in with that. Let's get the big headline from Uttar Pradesh. In a big jolt for the state's real estate sector, some reports emerged that a group of UP ministers directed the Noida police to arrest 8 developers in the state as they have failed to deliver 5,000 flats to home buyers. Manisha Natarajan is here with the details on this development. Manisha, the state has cracked the whip on the real estate sector very clearly. Was it left with no other option? And what really is the road ahead now? What's the option?
Well, it seems that, yes, a whip is being cracking, but the office of UP ministers who were part of this committee which met is denying that they have actually ordered an arrest. Inside sources from Noida Authority have said that it will be decided that after the ongoing audit, there is an ongoing audit of the accounts of the builders, and if the builders are found to have defaulted deliberately, will any action be taken, arrest or not? Now, we remember that August 22nd, UP Chief Minister had constituted a 3-member committee to look at preparing a roadmap for delivery of these flats and set a deadline that 50,000 flats should be delivered by 2017. 1.6 lakh units across Noida, Greater Noida and Yamuna Expressway are delayed, as we've been told by Noida Authority. Now, FIRs have been lodged as well, but the big point to remember is that CREDAI claims 8,000 flats out of these 50,000 have already been delivered. Another 30,000 units have been almost ready and CC has been applied for. They will be given to buyers in the next 30 to 60 days. But we're still looking at a figure of 1.6 lakhs. So look at 1 lakh odd apartments still not sold. And there is a fight between builders and authorities. Last mile funding problems because serious financial disputes with the authorities. Banks are not disbursing home loans to customers because projects are shown as defaulter on the Noida website. Now that is where the problem lies. UP committee had assured the builders that they will speak to Noida Authority, recalculate the land dues to the authorities and give some respite to builders. It's very clear that if the builders do not get last mile funding, buyers are not going to get their homes. And despite RERA, buyers are likely to be stuck with cases till the end of 2017. Pretty dismal position even now, Kritika.
Okay, Manisha, thanks for joining in with that. We'll, of course, keep addressing that story as it develops. But